Hello everyone. My name is Majesty. I am an Atlanta-based real estate developer with 13 million in assets under management and another 50 million in the pipeline. I build and rehab apartment buildings, so stick around for some real estate investment tips. I'm doing a 100 question series of the common questions that I get from people that are interested in real estate investing, whether they're new or seasoned, and just trying to, I guess, pick my brain and maybe get an understanding from my point of view. And today's question is, what are the tax advantages of investing in real estate? What are the tax benefits that come along with real estate investing? And I'd like to highlight here that real estate has the best tax benefits and advantages of any asset. And I know I'm like some huge real estate advocate, but I mean that, and I'm going to prove it in this video by going over briefly some of the tax advantages. And just keep in mind that these tax advantages are specific to real estate. They do not apply to other assets. So that's important to remember. So tax advantages are very important in business, specifically in the United States, but just in general, because taxes are the largest expense that anyone has. It's not rent, it's not your car, it's not mortgage, it's not food, it's not gas. It is taxes. Taxes takes a significant portion of people's incomes. So tax avoidance is the name of the game, not tax evasion. That'll get you Wesley sniped. But tax avoidance is turn this down. Tax avoidance is the name of the game. How much money you get to keep out of what you make. And real estate is the best possible vehicle for that. So I'll go through it pretty briefly. But so number one, we have depreciation. And depreciation is basically a deduction that you get for the wear and tear of your property, your rental property. You can spread the cost out of this wear and tear over about 27 to 39 years, depending on if it's residential or commercial. If it's residential, it's on the shorter end. If it's commercial, it's on the longer end. And ultimately what this does is reduce your tax liability, your taxable income. But it doesn't reduce your cash. It doesn't reduce your cash out inflows. It doesn't reduce your actual cash, the cash that moves around. It reduces your taxable income. So you're able to write off more, which means you're able to keep more. And that's what this is all about: reducing your taxable income, the amount of money that the IRS has access to be able to tax. So number two is mortgage interest deduction, and that is exactly like how it sounds. Basically, you can deduct the interest paid on your loans, and this also reduces your taxable income. So while you are paying high interest rates right now for different things, it is for the most part deductible depending on the structure of your property. The other thing that number three is property tax deduction, which also sounds just like that. So you are paying property taxes on things, but you are also able to deduct those costs from your taxable income, which allows you to pay lower taxes. So you're going to kind of hear that over and over: reduce taxable income, because, like I say, what you keep is more important than what you make, which sounds backwards, but I'm sure we've heard a lot of people that have made a lot of money, but then didn't keep it. So it's very important that you're able to keep it, because it can be easy to make, but hard to keep. So, these are strategies that help you keep the money that you make. You have to factor in taxes and everything that you do. So number four is 1031 exchange. And this is when you're able to defer or basically delay the capital gains taxes that you would have paid on a transaction, but you are required to reinvest the proceeds into a similar, they call it like kind property, and this has to be done within a specific time frame. So you sell a property, and instead of taking the cash and paying your taxes and going and buying whatever, you don't take that money. You reinvest the proceeds into a like kind property, and this allows you to defer the taxes that you would have paid on that transaction where you made money. And this is once again about being able to keep the money without having to give it to Uncle Sam. And this is tax avoidance, which is completely legal, not tax evasion. You're using the IRS code to your advantage. You're using it to your benefit. It's in there for you to use. And this is part of why a lot of people were upset with Trump and his tax returns, is because he used these things to his advantage, like most developers and real estate investors do. Unfortunately, he had to kind of show his tax return, so it didn't look too good. The other tax benefit is capital gains. So number 5 is capital gains. And capital gains come in two versions. One is short term, one is long term. So if you hold an investment for less than a year, then it's short term. If it's over a year, it's long term, and you get a different tax rate based on how long you held it. So the longer you hold, well, if you hold it over the year, then you get long term capital gains rate, which is lower. And then if you hold it less than 1 year, you get the short term capital gains rate, which is higher. But each one of those are still lower than the tax rate for regular income. So it's better than the tax rate that people get hit with on their paychecks, if that makes sense. So investing is a strategy, like I said, to keep more of your money, as opposed to kind of letting it just go out before you even get a chance to see it. So another number 6 is the deduction of operating expenses. So all of the costs that you have, property management fees, maintenance, repairs, insurance, advertising, those costs are deductible, which once again reduces your taxable income, which is very important. And then another one is number 7 is pass-through tax deduction. So certain investors that qualify for this are able to deduct a portion of their business income based on whether they have a pass-through entity or not. And pass-through entities are LLCs, S corps, things like that. And once again, that lowers the taxable income, which the IRS has less to tax. And number 8 is tax-deferred retirement accounts. So this is like your self-directed IRA or your 401k. These can be used to invest in real estate and have your earnings from those investments grow in a tax-deferred or possibly tax-free manner, depending on the type of account that you have. So that's a quick rundown of 8 different tax benefits and strategies that are specific to real estate that can significantly reduce your taxable income, which allows you to make $1 million. But when the IRS looks at you, they only see a little bit. So that is something very important to consider. And you want to think about your tax strategy while you're operating your business, because you don't want to just make a lot of money and then have it all be taxed. So with that said, also make sure that you consult a tax professional when it comes to this. I'm not a tax professional, just kind of walking through some advantages at a very high level. So make sure you consult a tax professional for these things. And like, share, subscribe, you know, all that good stuff. Please comment. Thank you for the questions. I appreciate the engagement, and thank you guys for checking out this video. Until next time, bye.